it's likely that the price of the asset will adjust to make you whole. And that has been what's happened historically. So there's been this built-in kind of number go up element to Bitcoin. Yeah, look, I think the way I describe this is, again, you've lived here in North Carolina, you've been in Chapel Hill before. Every so often, maybe once a decade or so, we get a late spring or an early spring, kind of late winter storm. So everyone thinks winter's over and, it's March-ish or even sometimes April. And we get this big nor'easter that just sits off the coast and just dumps snow, picking up all the moisture from the ocean. And we kind of had that. The nor'easter was, Hurricane Sam, Sam Bankman-Fried, SBF, for all who follow, turns out really, really, really bad guy. And lots of bad stuff are likely to come out of this as the details become public. But that storm was really unexpected. I said that kind of June 15th of this year was the end of crypto winter. So we have this seasonal period in crypto, follows a 4-year cycle. Why 4-year cycle? Because that's the halving cycle in terms of Bitcoin block rewards. Why does that induce a cycle? Well, think of it this way. If you're a miner, right? Miner is someone who takes computers, dedicates them to the network, and then is paid by the algorithm to secure the blockchain. And you have pretty much fixed costs. Your electricity costs are fixed, your land and rent are fixed. And so if the amount that you're being paid for providing that service gets cut in half, if the block rewards get halved, it's likely that the price of the asset will adjust to make you whole. And that has been what's happened historically. So there's been this built-in kind of number go up element to Bitcoin. Now, that's fine, and that makes sense. But the problem is the difference between price and value. So the value of the Bitcoin network can actually be calculated pretty accurately using Metcalfe's law, looking at the number of users and the participants in the network, looking at transaction sizes and volumes. And so we can actually come up with a pretty good method of calculating fair value. The problem is the price of any asset doesn't necessarily reflect fair value all the time. So what happens in, let's call it, crypto spring is, price is roughly around fair value. There's a little bit of volatility and the investors are there, right? Investors buy assets when they're below fair value, right? That's what they do. And they're one of 4 market participants. So second market participant are traders. Traders don't really care about value. They just want movement, right? They want to buy stuff that's moving up. They want to sell stuff short that's going down. And they're trying to scalp little bits and pieces. And that's perfectly fine. It's a really hard game. Most people are really bad at it, but knock yourself out if you want to try that. Then there are speculators. Now, speculators are interesting. People think of speculators as people who are betting on the markets. No, that's the 4th category, gamblers, which we'll get to in a minute. What a speculator is the opposite of a hedger. Okay, a hedger, right, a miner, right, produces Bitcoin. They need to sell that production to convert to fiat to pay their electricity bills and their rent. So they will sell, sometimes in the futures market, the forward production, and a speculator has to take the other side of that trade, right? For every trade, there has to be a buyer and a seller. So if a seller is selling in the futures market, a speculator has to come in and buy. Now they are speculating that the price will go up, or else why would they buy? So that's a good use case for speculators versus hedgers. The problem is gamblers. So what happens in crypto spring is the investors start to accumulate, the traders get involved as the price starts to move. Maybe there's some hedging and speculating going on. But as the price rises, it then starts to rise above fair value. Well, why? Well, as people invest and it works out, they become bolder and they invest more. And then if it keeps working out, they get bolder and then they borrow money, right? They take margin loan and they borrow. So here's what becomes the problem. As that price starts to move away from fair value. So let's go back to 2017. So in 2017, the Metcalfe's Law fair value in November of that year was about $10,000. And we went from kind of $4,000 or $5,000 all the way up to $10,000, hit $10,000, I think November 8th of 17 or whatever. And then everybody went home for Thanksgiving and orange pilled all their friends and relatives. And the price started flying. And over the next 6-7 weeks until December 18th, the price got to $20,000. Why? Because the gamblers showed up. Gamblers are people who have no idea what they're doing. They just see number moving. I'm gonna buy. I'm gonna speculate. I am going to lever up. And the problem is in crypto, you can use a lot of leverage. There were people offering 20, 50, in some cases 100 times leverage. Absolute insanity. I mean, Bitcoin is an 80 vol asset, volatility of 80. You should never lever that. Maybe you could get away with a turn if you were really good at risk management, but 100x, stupid, silly, 50x, stupid. But they do it. So the price got all the way to 20,000. Well, then what happens? Okay, now suddenly there's